What if you could analyze companies' financials just like Warren Buffett using an income statement? Today I'm going to show you exactly how Warren Buffett picks his long-term winners step by step. We'll dive into insights from Warren Buffett and the interpretation of financial statements by Mary Buffett and David Clark. By the end of this video, you'll be able to think like Warren Buffett and spot the best investment opportunities for massive returns. Let's dive into it. So why do we care about income statement in the first place? An income statement is like a financial report card of a company. It shows if the company is making money, profit, or losing money, loss, over a period of time, like 3 months or a year. This document helps investors to decide if this company is really worth investing in. The income statement has 3 main components. Revenue, how much money the company made from its sales. Expenses, the costs incurred to produce or sell those products or services. Net income, the profit left after all expenses, including taxes. And Buffett categorizes companies into 2 different groups. Number 1, companies with a long-term competitive advantage. These companies can consistently maintain strong profitability year after year. Number 2, companies without it. These businesses struggle in competitive markets and often don't show consistent profitability. Buffett uses income statement to figure out which group a company belongs to. The first item on the income statement is revenue, which is the total amount of money the company earned from selling its products or services. Buffett looks for, first, revenue growth. He focuses on companies that show steady revenue growth, as this shows their products or services are in demand and that the company is expanding. Second, quality of revenue. Buffett prefers companies generating revenue from regular, ongoing operations. He thinks that if revenue mainly comes from one-time sales or selling assets, it might not reflect true business growth. But revenue is just the beginning. What really matters is what happens after. The next key figure is cost of goods sold, COGS, which is the cost of producing the goods or services a company sells. It includes things like materials, labor, and production costs. Here's what Buffett looks for. First, lower costs. Buffett prefers companies that manage to keep their production costs low. Lower costs mean higher profits. Second, economies of scale. Buffett prefers companies that benefit from economies of scale, which means that as companies grow, their cost per unit produced should decrease, allowing them to keep more profit from their revenue. Buffett uses COGS to see how well a company manages its costs. Companies that keep COGS low while generating high revenue are more likely to have sustainable profits. Next, subtracting COGS from revenue gives gross profit. This shows how much money the company made after covering production costs. Then Buffett looks at gross profit margin, which is the percentage of revenue that becomes profit after covering COGS. It's calculated as gross profit divided by revenue. Buffett prefers companies with high gross profit margins because it shows they can sell their products at a premium price and keep more money. For example, Coca-Cola has a gross profit margin of over 60%. Second, consistency. Buffett likes companies with consistent gross profit margins because it shows they have strong control over their costs and pricing. Third, competitive moat. Companies with higher margins usually have a strong competitive advantage, protecting it from rivals. Companies with gross profit margins over 40% tend to have a durable advantage, while those below 20% are usually in highly competitive, low-margin industries that Buffett avoids. Next, we have operating expenses, which cover the costs of running business that aren't directly tied to producing goods, such as salaries, rent, marketing, and office expenses. The first operating expenses is selling, general, and administrative expenses, SG&A, which include advertising, office supplies, and administrative salaries. Buffett focuses on SG&A costs to understand a company's efficiency. Here's what Buffett looks for. First, SG&A percentage. For example, companies like Moody's spend about 25% of their gross profit on SG&A, while Ford spends up to 80%, making it less efficient in converting revenue into profit. Second, consistency. Just like with operating expenses, Buffett prefers companies that manage their SG&A costs consistently. For Buffett, large, unpredictable jumps in SG&A spending signal trouble in managing costs effectively. Another key operating expenses Buffett examines is research and development, R&D, which are the costs of developing new products or services. While innovation can be important, Buffett tends to prefer companies that aren't overly reliant on R&D spending to remain competitive. Here's what Buffett looks for. First, lower R&D costs. Buffett avoids companies that spend heavily on R&D because there's no guarantee the investment will pay off. A high R&D budget can be risky, especially if the company's innovations don't lead to increased profits. Second, stability. Buffett prefers stable companies like Coca-Cola, which don't need consistent innovation to stay profitable. They have well-established products that don't require large R&D spending to maintain their competitive edge. Moving on, the next one is depreciation. Depreciation reflects the gradual reduction in the value of physical assets like machinery or buildings over time. Buffett treats depreciation as a real expense because these assets will eventually need to be replaced. Here's what Buffett looks for. Real costs. Ignoring depreciation can inflate a company's profit, so Buffett expects companies to properly account for it. For example, if a company buys a $1 million machine with a useful life of 10 years, Buffett expects them to spread the cost by subtracting $100,000 in depreciation each year over its life. Now let's talk about interest expenses, which are the costs company pays to borrow money. High interest expenses can be a red flag for Buffett because they tell that the company is carrying a lot of debt. Here's what Buffett looks for. Buffett prefers companies with little to no debt and lower interest payments. Companies with high interest expenses have to spend too much of their earnings just paying off debt, which leaves less room for growth. For example, Southwest Airlines pays just 9% of its operating income in interest, while United Airlines pays 61%. Buffett prefers companies like Southwest Airlines that don't rely heavily on debt. What's coming next is income before tax. Income before tax shows how much a company earns before income taxes are deducted. Buffett uses this number to compare companies and assess whether the company is growing its profits over time. Here's what Buffett looks for. Steady growth. Buffett prefers companies that show steady growth in income before tax. Consistent growth shows that the company is reliably making money regardless of changes in tax rates or industry conditions. Net income is the final profit left after all expenses, including taxes, are deducted. It's the most important figure on the income statement and gives the clearest picture of a company's profitability. Here's what Buffett looks for. First, historical upward trend. Buffett prefers companies that show a steady upward trend in net income over many years, ideally over a 10-year period. This consistency suggests the company has a strong, durable business model. Second, higher net income as a percentage of revenue. Buffett also looks at how much of a company's revenue is converted into net income. For example, Microsoft converts about 30% of its revenue into net income, while Walmart only converts about 2 to 3%. A higher percentage means the company is more efficient at turning revenue into profit, even though it differs between different industries. And here's the general rule Buffett follows. If a company consistently shows net income over 20% of its total revenue, it likely has a long-term competitive advantage. If it's below 10%, the company is likely in a very competitive market. Finally, we have earnings per share, EPS, which shows how much profit a company makes for each share of stock, calculated by dividing net income by the number of shares outstanding. On the income statement, EPS is usually displayed at the bottom after net income. It's an important indicator for investors because it reveals how much profit is attributed to each individual share of stock. Here's what Buffett looks for. First, EPS growth. Buffett likes companies that have a steady increase in EPS over a long time, usually around 10 years. This shows the company is consistently making more money for its shareholders, which is a good sign of a well-run business. The growth doesn't have to be perfect every year, but the general direction should be upward like this. This kind of steady increase shows that the company is doing well over time and can keep growing their profits. Second, no tricks with share buybacks. Sometimes companies make their EPS look better by buying back their own shares, which lowers the number of shares without actually making more money. This makes EPS go up without real growth. And Buffett prefers companies that grow their EPS by earning more, not just by shrinking the number of shares. Third, stable earnings. Buffett stays away from companies with EPS that goes up and down wildly from year to year. Big swings mean the company might be in a risky or highly competitive business. Here's an example of a company with unstable EPS, which Buffett avoids. These big swings make it hard for investors to predict future profits. So there you have it, guys. That's how Warren Buffett analyzes income statement to identify companies with massive long-term returns. If you have any questions or thoughts, let me know in the comments. And if you found this video helpful, make sure to like and subscribe for more. Thank you so much for watching.